point at the moment. Well, Markus Helsing from JB Markets joins us now from our Melbourne studio. Can we talk iron ore? Always a fair bit of interest in iron ore, but in particular, speaking a little bit earlier this morning to an analyst talking about, you've seen the spread between the fines come in a little bit, obviously a positive for someone like a Fortescue, which produces a lower grade ore. I mean, is that what you're seeing at the moment, that spread contracting?
Yes, look, exactly. I mean, the backwardation, which is futures prices trading below spot prices, has been quite enormous. I mean, just a year ago we were at $10, where 12 months out the futures price would have traded $10 a tonne below spot prices. Now this 1 year gap is at $1, which is what we would consider a relatively healthy market. A real healthy market would be a contango. Whereas the futures price is trading at a premium to the spot prices. Now, I guess you can't wish for everything, but that's probably as good as it gets. Look, for us, really, I've just spoken to some colleagues, some business colleagues in China, currently in China, traveling, and they're just saying that they're there every 2-3 years in a business trip, and they're just summarizing that the infrastructure build is just so enormous. They just wonder where they need any more future iron from us, because they reckon it's so much built. So I think that might be an issue down the track. But at this point in time, iron ore and in a particular coal that goes with it to produce steel is in high demand, and we, quite frankly, at this point can't fault it. So the terms of trade due to that for Australia remains very positive. So that's, in a moment, just a very good story.
So the view, at least in the near term, is you expect to see prices push higher?
No, look, I think it's probably mulching around the $65 a tonne, between $60 to $68 a tonne. We wouldn't be surprised at some point. It doesn't need a big hiccup, just a little hiccup to sort of see iron ore trend back towards the $50 a tonne level. But at this point in time, it finds the market seems to us very balanced, and there's no reason to be negative about it at this point in time, to the opposite probably. But we find that the market price is in balance, meaning, in other words, between $60 to $68 a tonne. I reckon that's as good as it gets.
Where are you at in terms of oil? Sentiment-wise, what are you seeing as far as the outlook for price there, Marcus?
We all know the Saudis are going to float Aramco, and they're truly in bed and in the same boat than Russia, so they're really they obviously have an extremely conflicted situation. They're highly interested to get the oil price towards the $80 a barrel level. We are all at JB Markets of the view that they will be successful, because, I mean, that is their last big bite of the cherry, and we really believe they'll give it all. And with the added support of Trump, may I add, I mean, speak about a conflict, I mean, this Iran scenario, by basically shredding the agreement with Iran about denuclearization, does come at an interesting time when you think about that. You know, I mean, the Saudis need to have a higher oil price, and Trump comes to the rescue. So I mean, there's a lot going on. So we really believe generally the underlying demand, without getting too carried away about the Trump factor, the underlying demand for oil is very healthy. And we don't see a reason why the Saudis, the Russians, or the rest of OPEC would change their output ceilings, because they have a common interest. So for the time being, with the economy going at full throttle, there's a fair chance to see $80 a barrel at some point in the next 6 months. That's our view. Because,
I mean, there's a belief in the market that at the upcoming OPEC meeting, they're going to get rid of the freeze on supply, as far as being able to increase supply. At the same time, you've had the US president, come out and say, you know, that oil prices are too high at the moment. You know, there's the concern that it's going to get to a level that starts to impinge on economic growth.
Well, that's very well, but I mean, Trump does say a lot of things, but the market forces are obviously a totally different story. But at the end of the day, our view remains that the output ceiling will remain. And, I mean, they'd be mad to lift them now. They're trying to float their biggest assets of the whole country of, God, nearly 30 million people. I mean, they'd be absolutely mad. They just saved the oil price from going into the absolute doldrums. So they'd be absolutely mad to stop the ceiling now. So we don't believe that at all. We believe the ceiling will stay probably for another 12 months, as far as we're concerned. And oil is heading towards $80 a barrel.
Okay, and so what do you see as being the catalyst to get it to $80? It's the fact that the market is wrong on the belief that they unfreeze the ceiling and just natural demand?
I reckon that the natural demand actually is a very underestimated factor, actually. I mean, the net demand actually at this point in time is accelerating. I mean, you have every economy in the world pretty much at full throttle. And of course, the US factor should not be underestimated. There are obviously also, at these price levels, far more activity in drilling and all that. But we haven't really seen a negative effect of that yet. So that's another reason why we fundamentally, but also technically believe this whole oil rally that started, we were very bullish, as you all know, in November, December. And we really believe this rally, while it could correct a bit more here or there, back to $60, $65 again, overall, we think we're in a bull market in oil, and this bull market has a lot more legs to it from the demand side as well as from the supply side. I mean, come on, it's a very restricted, cartelized type market. So that is an ideal scenario to actually put a squeeze onto a particular market, and we think that's happening.
I guess we'll see, won't we, at the OPEC meeting. Markus, what about gold? I mean, you've been a gold bull for a long time now, as long as I can remember having spoken to you, and we're still waiting, buddy. When are we going to get that rocket ship under the gold price?
Yeah, it's a tough laugh, this one. And look, at the end of the day, you know, you've seen Bitcoin go from 10 cents or $1 to 20,000. We still believe silver that's trading at $16.60 in a moment an ounce in US dollars. We still believe that's heading towards $250 an ounce. Now, what will trigger such a mad move? Well, obviously, a take two of what happened in 08. We still believe what happened in 08 was the LFC, the little GFC, the little FC, and the GFC is to come. I mean, we are in an extremely geared world, and I think we should enjoy what we have in a moment. At this point in time, we are booming and we're going absolutely full throttle. Now, we just find there's a lot of build happening, obviously in debt in the Western world, inclusive China, and you look at junk bonds. The accumulation of very, very bad debt, literally all around the world, is just absolutely astounding. So anyone who just has a decent, moderate view about things in the world should start to think about hedging their bets, and that's what we're doing. And so gold and silver is a tough love affair, and sometimes, as Warren Buffett would say, you make the big money out of patience. And unfortunately, gold and silver is not any different. So we really believe, particularly now, gold and silver, it's a must-have, 10% of a portfolio for any investor. At some point, the rewards will be immense. That's our view.
All right, Markus, as always, we appreciate getting your view, so thank you.
Thanks very much.
Markus Helsing there. We need to take a break. When we come back, we'll take a look back at what's been a data-rich week here locally, plus a look ahead to what to be across for next week with Justin Spurk from Westpac, so stay with us.